Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my opinions as we go through it, like we normally do. And let's just dive in there and see what's going on. If you want to follow me, it's at Finance. If you want to join our community, finding-value.com, we do have a discount going on. It is LEAP, L-E-A-P, because we're in leap year. Happy leap year. So Rory says, I dislike commodity price ratio based analysis as a theme. But in this particular case, it irks me, given that all else equal, it should have the opposite effect. He says, lower natural gas prices mean U.S. producers and thus U.S. production growth need a higher crude price to break even. Yeah, I don't think these guys know really what the heck they are doing. Mike McGlone, I know this guy's like a perma bear. Slumping U.S. natural gas prices have bearish implications for all commodities, particularly oil, is what he says. WTI futures trading at about 48 times natural gas are close to the 2012 peak that preceded a 30% decline in crude prices, according to Bloomberg Intelligence senior commodity strategist Mike McGlone. So he's got elevated crude versus gas may show too hot for oil. But here is the thing. Weather is what is causing this. It's not a steady supply where demand is actually getting crushed. So I would be very, very careful listening to anyone actually read data because I have seen this so many times with so many people, and a lot of them are on YouTube. And I'm not saying Mike McGlone's on YouTube, but what they do is they look at history, they look at the ratio, and then they try to draw conclusions from the ratio. So if the ratio is cheap for natural gas, which this is the white line there, that's natural gas ratio, he's going to say, oh, it was here, so we're going to have like a crash. There's no crash here. I mean, it was eventually way back over here, but this deals with the shale oil and shale really kicking on there. Um, we don't have shale oil, and in my opinion, at some point in the future, we could see the oil to natural gas ratio blow out in favor of oil because oil is going to require a gigantic premium at some point in the future because of how easy it is to transport, and that is where I think a shortage will and could occur. I think natural gas will be extra volatile, and the ratio is going to move. It's going to compress and it's going to expand over time. Because what's going to happen is we've got renewables that are largely driving this. I'll call it natural gas is the swing producer for electricity power burn. So power burn, they burn natural gas for electricity. With renewables and the adoption of more and more renewables, if there's nothing in the system to buffer those renewables, natural gas is going to take the load because it's the swing producer. If something occurs where renewables are not generating power, that like let's say not much wind on an overcast day, then natural gas is going to be burning a whole bunch, and that isn't necessarily projected in the mix here. It's all unknown. We don't know exactly what the weather is going to be like this summer to the day. So there's a lot of variables for natural gas. The weather is also another variable. So the weather for renewables and then the weather in terms of how hot and how cold also impacts power burn and heating. So that all impacts natural gas. We had a warm weather. We've had warm weather this winter, and that has impacted natural gas in a negative way at this current time. But I wanted to talk about that, and I think they're not reading the ratios all that correctly. Calvin says it's almost like cyclical investment plays out over years, not days. Well, that's true. So Calvin has good picks. Calvin is a genius when it goes up. Calvin's an idiot when it goes back down. It goes sideways for about 6 months or so, and then it starts going on up. Guys, some people will say this. I hear this all the time. Being early is wrong. I would like to jam that up a lot of people's butts because When you're early and you get in at the bottom here, if you cost average in and then you can ride this, there's no one that's going to match your returns. No other strategy is going to match those returns. Some people will say, oh, when you were down here for maybe for 6 months, as it bottomed out and was working its way on up, putting in a bottom, people will say it's not working. You're wrong. It takes time. Calvin is right. He's right on his picks. I've seen a lot of his picks. And I'm right on my picks too. Sometimes when you're trying to buy a bottom, it takes time. And then tell me who is day trading that earns 455% in about 4 years? Not that many. And if you got a bunch of positions, and some of these positions I took in 2020, I'm up 20x, over 20 times my money. I hate to say it, but that is close to, some of these people's entire careers. If you could 20x the entire portfolio. Now my total portfolio didn't 20x. It was more like a 7 or 8x. I think it was somewhere in there over that period. And you have to be patient. The strategy works buying undervalued companies, and then you have to be ultra patient for it to work. That is the strategy. His strategy is nuts on. These shipping companies are nuts on. Here's another one I'm sharing with Calvin. He says a heartwarming message from someone who has been a blog subscriber for 2 months. Quote: another idiotic Twitter trust fund guru leading his subscribers to ruin. Hope your subs keep you fed because your investments aren't. And my portfolio during the time he's been writing the blog in 2020-ish or 2021, he's up, 300 and maybe 300 and something percent. That's a very, very, very good return. Very good. So you've got a lot of people who are not patient enough. What they do is they think what they think the market is like is where you just buy something, it goes straight up, and then you sell. That's not how investing works. That's not the strategy that he is deploying. His strategy is to buy bottoms and hold for probably 5 to 10 years of the entire bull market. That's my strategy. And when you do that, you can get these outsized returns, basically just like his. And what you do is you have to buy it when it's cheap and it's unloved and the sentiment is really bad. That is very hard for people to do. It is very hard for people to do. And this is what you'll get. You'll get another idiotic, blah, 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 all this crap. And I feel for Calvin, man. Like the strategy works. It's just people don't know how to implement the strategy. They don't have enough time in the market. They need to learn how to invest in order to make money. You have to realize that when you first take positions, there's a good possibility that you didn't catch the bottom within 20, 30, 40%. If you're within I would say if you're within 50% of the ultimate bottom, you are killing it. Like you are literally catching the bottom. If you're within 50% of the bottom, a lot of these stocks, they may go down 80, 90% from peak to bottom in a cycle that is not favorable for commodities. But then when it turns into favor and we squeeze the commodity, that's where you make decades worth of returns in years. It's totally, totally, totally worth it. But in order to do that, you're going to ride through some volatility. And that volatility is going to eat a lot of people up because they don't know what the hell they're doing. They have no idea what they're doing. And what they're going to look at, they're going to see that they're down 30% in that position. They know nothing about the position. They know nothing about the company that they've bought. They have no idea where they are in the cycle. Of course, they're going to run scared and talk a big game. They have no idea what they're doing. So you got to learn, guys. You got to learn and figure out how to buy these bottoms and then ride them on up. And it takes and requires a lot of patience. Money supply growth is an essential component for the stock market. Both have risen 4,500% since 1967. And here's that difference here. Are we going to drop in the S&P 500 to meet the M2 money supply? I don't know. We'll find out. But it is in a bubble. Kobayashi letter. While AI stocks are still hot, mentions of AI in earnings calls are down sharply. In quarter one 2024 thus far, there have been only 200 mentions of AI in earnings calls. This is down sharply from the 750 mentions seen in quarter three 2023 and 500 mentions in quarter four 2023. So here it is, big move up, big move down in AI being mentioned in earnings conference calls. Go down. Here's U.S. oil, inflation 2.2 inbound, peekaboo, breaking out using, I don't know what month, if that's monthly close or something. I don't know what his time frame is. It looks like it's probably weekly or monthly. But here we are breaking out to the upside today. And that's going to lead to probably higher inflation and higher interest rates. Dan says this is oil 101. It's why markets hear Saudi energy minister, I don't know how to say that name, focused on keeping the oil market in balance. Inventories reflect supply versus demand, and he knows oil prices follow changes in inventories up or down. It's a matter of time. So the relationship between oil prices and OECD commercial oil inventories year over year changes, and you can see that. And I looked at the dot plot a few days ago, and fair value for the commercial OECD inventory level is roughly $80 a barrel. If you want to know what it is real time, but this is the data supporting that viewpoint. We had housing permits come in at 1.47 million, and we had housing starts at 1.33 million, which is right around average. This is the housing permits. So permit issues placing in total units, 1.47 million. And this is new privately owned housing unit starts, total units, 1.33 million. So we did come back down a little bit, but we haven't broken down below average yet. If we do break below average, there it is right there, coming back down. If we do break below average, and this is housing permits, if we do break below average, we could potentially see a slowdown in the market. That's generally where unemployment comes up. So we have to start looking at construction workers and unemployment from construction workers. That would be next. Here's a lesson, I would say. So reminder, don't be an idiot like the guys on WSB full ported SMCI yesterday and lost it all. Never fail. So save my life. Somebody, some whale out there, please come in and give us a big green candle on SMCI. I've been playing options on this one all week. Things seemed risk averse with the steady price movements. I'm down $70,000 today. I almost lost my entire portfolio. It's gone on zero FTD calls at 1,000. Please, WSB gods, please send this thing back up so I can sell and just break even or even lose 20 grand. And this is his life savings that he put on SMCI $1,000 call options, and he's down $72,000. And he's got put his value is 11,882. So he basically put everything on the line in SMCI. Wow. Now this is at a peak, guys. You look at the chart on SMCI. We can go over it here in a little bit. I've got that on there. This is what you don't want to do. This is how you get crushed. Too much risk. He has a poor company selection because he's trying. I mean, basically this thing's topping out. And two, he put options on it, which is even worse. And then he put options on, is that zero FTD? Like zero, I don't even know what that is. This is probably an out of the money call option or something on there, but what a bad decision. Well, hopefully he doesn't do anything stupid. Hoping for a rate cut. Think again. Pivots cause crashes. No, they do not cause crashes necessarily. So historically, what generally occurs is you see weakness in the market, the Fed pivots, and then you get a preceding crash after they pivot because the market is already weakening. The question is, are we weakening or are we going to strengthen into inflation? And what are the drivers of this? If we continue to have high interest expenses, lots of fiscal spending. If we have all that on that side, and let's say weakness is in the market, but they continue to have the inflationary fiscal spending side, I don't know what interest rates are going to do. Like, I don't know which direction they're going to go. Are they going to fight inflation or are they going to try to save the stock market and employment? I don't know. That's the position that Powell's in. So this is all based off history. You have weakness in the market, the Fed pivots, and then you see a decline in, uh, basically you see employment kick up, a decline in the stock market, decline in a lot of things. And that could happen. That could happen. But this time we do have a lot of fiscal spending, which I think will mask a lot of things from a nominal perspective. Here's Calvin again. He says it's almost like expecting every stock pick to work out within 90 days is unreasonable. So this is Petrobras. He says you buy in here, you are wrong as it comes back down. Wrong timing right here. Says lots of laughs. Rest in peace, Calvin. Back in this area, and then look at the move upward. Big move up from April of 2023 all the way on up. Now, if you guys are trying to time this stuff in the short term, it's incredibly difficult, and you got to have longer time frames than what most people have. So here's SMCI. This is fine. This is perfectly fine. This is where that person lost all that money. They put it on at 1,000, and here it is, ripping to the downside. Massive, massive move to the downside. And I don't know if it closed here or if it came back up a little bit, but this is the rug pull. This is where you can massively lose money. Be very, very careful. Buy things when they're undervalued, buy things when they're cheap, and then have a long-term time frame. This stuff won't kill you. Options on a short-term, price-based movement, along with the move that this thing has already had, and along with a potential overvaluation and a peak, this is just asking for a total raping here. I mean, no bueno. Breaking super microcomputer, it's the same chart, sees a 30-point drop in its daily RSI, and the day after becoming the second stock in history with a 97 plus daily RSI. This is the same exact setup that we saw in GameStop, GME, on January 27th, 2021. After that day, GameStop never broke above its all-time high again. SMCI is currently down a massive 25% from its all-time high of 1,077, which was just seen a few hours ago. Could this be the top for SMCI? Yes. This is a bearish engulfing that's massively going down. Yes, we could see it go up a little bit and see some volatility behind it. It could even do a double top, perhaps, maybe. But this thing does not look good. This is what a top looks like to me. JC says, I really like Apple short, but I like Microsoft short too. Apple is much worse, but I think Microsoft looks vulnerable as well. This really might be the most important chart in the US stock market right now. And this is the technology versus S&P and how we can see a technology underperform the S&P 500 and go lower. And we can also see the RSIs going lower. The Google Trends searches for call options hit a 2-year high this week. One would think it's not professional asset managers looking this up. So this is everyone looking at call options at the top and peak of a NASDAQ bubble. This is more evidence that we are in bubble territory and that we can easily see this come lower. The big boys that are pretty smart, they're getting their shorts on. They're getting their shorts on, and Bezos is selling out. The insiders are selling out. This is a peak, most likely. And it could go up higher. I mean, that's why I just don't play these things. I don't play in this area where you can lose money very, very quickly, and you won't get it back. It's not going to come back, guys. So Google could see an acceleration to the downside if we lose the 50-day SMA. That thing's fallen lower. Now, here's another thing I want to talk about. I know a lot of people like uranium, and I know a lot of people watch my channel that watch uranium. Uranium has gone up the same time that this NASDAQ has gone up. And there is a correlation between NASDAQ and NASDAQ stocks and uranium. Are we going to diverge from that, or is this going to yank us lower? I don't know. We'll have to find out, but that is something to think about. Financial conditions today are easier than when the Fed started raising interest rates back in March of 2022. As seen in the chart below, financial conditions today are actually near their best since January of 2022. The same picture can be seen in conditions from the Chicago, St. Louis, and Kansas City Fed. With core CPI inflation still around 4%, this will be a problem for the Fed to be returning in terms of interest rates. So this is the United States financial condition. The Fed starts raising rates, and now we're back to loose monetary conditions again. Are they going to try to bring this back down or what? Don't know. Are higher for longer going to stay in place? Or are we going to raise rates here? It looks like we might. S&P 500 SPX to 6,500 by end of 2025, says Capital Economics. So we still have some bulls out there talking about the S&P 500. Bubble may be far from bursting. Capital Economics says S&P 500 could hit 6,500 by end of next year. That's what their opinion is. Here's oil demand. So this is oil demand in OECD versus non-OECD in million barrels per day. So we actually have a decline in OECD oil barrels of oil demand from 2004, 2005, and it comes on down a little bit. But that is being completely washed over by non-OECD, ripping to the upside in a 45-degree fashion from 1995. It's just a 45-degree line higher. So yeah, non-OECDs in their ramping of their S curve for energy consumption. It's probably going to be a bunch of oil demand and a bunch of natural gas and fossil fuels and coal. Here is new all-time lows today for Treasury bonds relative to the S&P 500. Do Treasuries on an absolute basis now follow suit? Now that's interesting because this is the U.S. Treasury bonds going lower, and we continue to go lower against the S&P 500, TLT divided by SPY. Are we going to continue to go lower where we get higher interest rates, perhaps? I think that's going to be the case. I think that's going to be the case. We had that case here in 2023, April, May, and I think that's going to happen again. Funds are now the most underweight energy stock since December of 2020. So here's December of 2020, which is probably right in here, or no, maybe it's around here. So this is underweight, and this is where I like to look. I would be a buyer September 15, April 20, February 24. Yep, I like it. I go where people aren't, and that is where, I mean, you're not going to find people throwing on call options in energy right now. No one gives a crap about energy. And that's exactly when you want to buy. You want to buy when sentiment's really bad. Inflation higher for longer. It says you are here. You can see the three waves. The only thing that I'll say about this, guys, is during some of these waves here, I mean, every single wave that we have, those were all real estate cycle movements. Real estate crashed, real estate crashed, real estate crashed. So we're not in a real estate crash at this moment. And I think that we could be going on up here soon. And I think the numbers are pretty doctored up too. So I don't really know what the real rate of inflation is. It's probably much higher than what people think. There's a bunch of hedonic adjustments going on and substitutions. Peter Schiff said, why would inflation fall back down to 2% given the surge in deficit spending and consumer borrowing, as well as weakness in manufacturing? It's far more likely that inflation rises back up to 9%. The Fed and investors have the inflation story completely wrong. Buy gold now is what he says. Okay, that's an opinion. Here's Josh Young, another one that was sharing that sentiment. I don't know why I shared it twice. And that's what I've got for today, guys. So that's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got a question and answer session going on right now. If you're a member, head over to the question and answer session if you want to ask me anything, or if you want to participate in my training that I'll be doing today. And If you want to join, you can use the word LEAP, LEAP. You can get in there, and I'm going to be talking about companies, uh, like a overall big picture 30,000 foot view of what a business is, how a commodity price links to you as a shareholder, what that linkage is. And then I'm going to go into, after that, natural gas. And I'm going to give you the three pillars, all that stuff. So that's what I've got for today. Hopefully, you guys enjoyed it. Don't forget to click the thumb up button, and we'll catch you later. This is Finding Value.